Vanguard offers 3 different equity funds or ETF that are expected to give you a higher level of dividends or income. And in this video, I'm going to compare and review all 3, so you know exactly what to expect from them, how much dividend you can expect to get, and what are the goods and the bads about investing in all 3 of these funds, so that you can decide for yourself whether it is something that you would want to invest in. Let's start with the first one, which is Global Equity Income. So Global Equity Income Fund, I'm looking at the income share class. So they also have accumulating share class, but in this video the purpose is to focus on the income, which is why I'm looking at this share class. So the main difference is that with this share class they will pay out the dividend to you in cash, while with the other share class they will hold that value back into the investment, so that your total value of investment actually grows faster over time. So the main thing to note is that it's actually an actively managed fund. So Vanguard is very popular to know as their index investing or passive investing, which is why they are able to offer you one of the lowest fees in terms of investments. But they also offer and carry out a lot of actively managed fund as well. So this one is one of them. So the next thing to know is whether it's a fund or an ETF. So this is actually a fund. So this one is actually a UK WIC fund, and it is not an ETF. If you're not aware of the differences between an ETF and an index fund or an actively managed fund, I have a separate video on it. Feel free to check that one out later. So the main objective of this fund is to provide an annual level of income. So here we're talking about dividends, which is greater than FTSE Developed Index. So here FTSE Developed Index is the benchmark of this fund. Together, they're going to try to actually keep up the actual value of your investment and grow it over 5 years or more. So what this fund is not promising you is to beat the benchmark. They are not promising you to do that, but they are promising you to give you a higher level of dividend compared to the benchmark. So this is a very important point for an investor to be aware of before investing in a fund, especially if it's an income fund that you are after. So how much is this going to cost you? So they're going to charge you about 0.48% per year. So whatever the performance of your fund is, regardless of whether it's going up or down, you're going to have to pay them 0.48% of your investment values. Because it is an active fund, which is why this number is a little bit on the higher end. But if you do compare this figure to other funds which are actively managed, it's actually at the lower end of the spectrum. So you are paying a little bit extra for an active fund, but it is not too high if you compare it to the market. In terms of number of stocks, so they have about 133 different stocks being actively managed and looked at for you, so that you have a well diversified exposure to the stock market. And let's talk about the distribution or the dividend yield number, because that's the primary objective of this video or this fund. So they have about 2.79% of dividend yield figure, and that was as of end of May. And they pay this out on a quarterly basis. So 2.79% is an annual number, but you get paid on a quarterly basis. So you can see that at the bottom they have the distribution type. So let's look at 2020. So they paid out the first dividend in March 2020, and they paid out 0.67 pence per unit of investment that you held. Then they paid in June, September, and then in December. So if I were to add up these distribution rate for 2020, it adds up to £3.58 per unit held. So if you invest or if you hold 100 units in this fund, you can expect to get £358 in dividend income last year, and you can expect to get something similar this year as well. And let's look at a little bit about the portfolio. So let's look at the portfolio data. So you get some characteristic number. We looked at the number of stocks held, so they only hold 133, but the benchmark, they have about over 2,000 stocks. So this fund manager, what they're trying to do, they're trying to pick the best 133 stocks out of this benchmark, so that you can get a better income versus the benchmark. And they have a median market cap of 54.2 billion versus 64.1 billion. What this tells you that the type of companies that they hold, they are a little bit lower in terms of market cap, so they're not as large as the ones held in benchmark, but that's not too significant. You have some of the valuation number. You can, especially if you're actually investing in an active fund, you would want to compare these valuation or fundamental data of the fund to the benchmark, because that tells you how well the fund manager is actually managing the fund or what is the style of investment of this fund manager. So the PE ratio tells you how expensive the fund is. So higher the number, more expensive it is. So on relative term, this fund's got a PE of 16.5 compared to 23.1 in the benchmark. It tells you that the fund is cheaper than the benchmark. That's a tick mark, so that's good. You don't want to overpay for your investments. Then you have the PB number, so price to book value. Again, it is similar to price to earnings, but this is against the book value. So again, higher the number, more expensive it is, more money you're paying per unit of book value of the overall portfolio. And then you have your return on equity number. With this one, you want the number to be high as possible. It's a quality measure. It tells you how much money you're kind of getting back on equities or investments being made by the shareholder. So their number is a little bit lower than the benchmarks, but I think we know why that is the case, because the benchmark is a little bit more expensive. So there is always a trade-off. If you want to have a high quality investments, if you want to invest in companies that are of high quality, you do have to pay up a little bit more for it. But this fund is not doing that. It's paying less than the benchmark, so it is getting a little bit less than the benchmark when it comes to return on equity. The same thing is again with earnings on growth rate as well. So this number is telling you on a year-to-year basis how much of the earnings growth you're getting in the portfolio and versus the benchmark. Again, because this fund is on the cheaper end, so they don't want to pay up too much for future earnings growth, because remember, it's an income fund. So you're getting a lower earnings growth number compared to the benchmark. So these are kind of tells you the style of the investment that you have. And the region level, you can see that is mainly about 50% of the fund is in North America and 33.39% is in Europe. Remember, the fund is measured against the developed market benchmark. So you should not expect to have emerging market exposure. However, you do have about 3% of emerging market exposure in there. And why is this the case? That's because it is an actively managed fund. So the fund manager can actively make decisions against the benchmark to give you a better return or give you a better income. So because it's an active fund, they're able to do that. If it was a passive fund or an index fund, you would expect to get exactly as the benchmark. So you would not expect to see any emerging market exposure there. But with this one, you're getting some. And then you have some allocation, further allocation by country. And you have some sector level information as well. It kind of tells you where the fund is overweight or underweight versus the benchmark. It is heavily overweight in financials. That completely makes sense, because financials and banks, they tend to pay out a stable amount of dividends. That's what they're known for, which is why the fund is overweight by 10.5%. Where the fund is definitely underweight, which again makes sense, is in technology sector. So the fund is about negative 15% underweight in this sector. The benchmark's got 21.4% of holdings in tech. The fund got 6.5. Again, technology companies, especially emerging technology companies, they hardly pay out dividend because they're still kind of growing. So there is no point for this fund to hold investments in there, because the whole purpose of this fund is to have higher dividend. So what to note by looking at this region is that if you think technology sector is going to do well over the next few years, then you're likely to underperform. So this fund is likely to underperform. But if you think financial is going to do well, which might be the case because interest rates are rising, well, interest rate will be increasing in the future, and with the higher interest rate, financials tend to do well. So if this fund is heavily in financials, you can expect the fund to sort of do well against the benchmark. And finally, in terms of what sort of companies they hold, so they hold 133, and the largest holding is in Bank of America, and they hold about 2%. So that's kind of giving you like a stock by stock information as to where the fund is holding their investments in. So they also hold investment in TSMC, Taiwanese semiconductor manufacturing company, but they are an emerging market company. So you can see that where you're getting your EM exposure from. So we can finish off with this fund by looking at some of their performance. It's always good to obviously look at performance, even though past performance does not give you any indication of future performance, but it's something to obviously to look at. So let's look at their summary performance, the month end of May. So the fund is in gray and the benchmark is in teal color. So you can see that year to date the fund is up versus the benchmark. And I think that's again making sense because so far this year, some of these financial companies, or what we call as cyclical or value companies, they have been doing well, which makes sense. But if you kind of look at over the long term, say over 5 years or 3 years, where you had technology companies doing well or growth companies doing well, the fund did not outperform. But then again, remember, the fund did not promise you of outperformance. All they have promised you is over 5 years or more, they're gonna try to increase the value of your portfolio, which I think they have been doing. So they have been meeting their objective in that sense. So that's the first fund I wanted to talk about. The second one I wanted to talk about is FTSE UK Equity Income Fund. So FTSE UK Equity Income Index Fund. So you can see in the name, it's an index and it's a fund. So what is this fund trying to do? The fund seeks to track the performance of FTSE UK Equity Income Index. Now, at this time, if you're not sure about what this index is, or what sort of benchmark it is, which is important to know because the fund will be tracking this, what you can do, you can quickly do a little Google search and go to FTSE's website to get you the fact sheets of the actual benchmark that this fund is trying to follow. So from FTSE's website, you can see that this index is actually characterized by higher than average dividend yields and is based on FTSE 350 index. So FTSE 350 index, they hold the top 350 companies in the UK. And the way this index is constructed, they kind of tell you here. So they don't hold any REITs in there or any investment trust. And if there are any stocks that are forecast to pay a zero dividend over the next 12 months, or have no forecast data, then they will remove those companies from this market index. And the rest of the stocks that within the 350 index, they will be ranked by their annual dividend yield. And the top 50% are included in the index. So they're gonna rank all 350 companies, excluding the ones we have just said, and rank it by dividend yield. So if one of the companies paying out 8% dividend yield, and that's the highest, they're gonna be ranked at the top. And then they're gonna take the top 50% of those companies and make it into an index. So we're really getting a pure large cap, high dividend yield companies in this index. Okay, let's go back to Vanguard's website and look at their distribution number. So that's where the income comes from. So they pay out semi-annually. So the last one you would get paid about every 3 months. This one you get paid twice a year. And the yield, so the amount of dividend yield you can expect as of last month was 4.46%. And if you do something similar and add up these two numbers, which are the actual amount of income distributed. So if you held about 100 units in this fund, you can expect to get £600 per year in pure dividend income. And if you look into their portfolio data, something again similar to what we've done, so you notice that how the valuation numbers or some of these return on equity numbers, they're very close to the benchmark. And this is happening because the fund is not trying to do something smart or do something, making active decisions. You are doing what the benchmark is doing. At the bottom, you see the turnover number. So this is 132.7 times. So higher the number, more times the fund has to turn over. So this is something to kind of keep in mind when you are investing in a passive fund or an index fund, because at the end of the day, the fund manager has to make sure that their fund is matching the benchmark. So more time the benchmark changes, the more times the fund has to make transactions, and at the end of the day, those transaction fees, they're going to come back to you. So higher the turnover number, the more cost is going to incur you as an investor for those transactions. Now, in terms of regions, we know it's all UK because they are literally just following an UK benchmark, and in terms of the sector, they are very closely following the benchmark. So again, financials and materials are some of the largest sector. So you can see the top 10 holdings here for your information. And finally, let's look at their performance. So if we do a summary, so because it's an index fund, it's supposed to be similar to the benchmark, and it has been. If you look at the gray bar and the teal bar as well, over 5 years, the return was about 3.8%. So it is not one of the highest returned market, because UK equity market has not been great for a long time. But if you look at their cumulative return over 10 years, is about 66.4%, and over 5 years is about 20.4%. So you are getting positive return of your overall investment over the long term. So when we talk about long term, it is pretty much 5 years or more. That's the framework that we tend to use. Right, finally, let's look at the last one. So the last one I want to talk about is FTSE All World High Dividend Yield ETF. So you can see in the name that it is an ETF, so it is not a fund. and it is an index strategy as well. So again, it is passively managed and it is not actively managed. So what is this fund trying to do? They're trying to obviously do the indexing against the benchmark called FTSE All World High Dividend Yield Index. So the index, they hold large and mid-sized companies and they exclude REITs. An interesting thing to note about this ETF is that they also hold exposure in emerging market companies. So the first one we looked at, it was an active fund against a developed market benchmark, but this one they hold emerging market stocks as well. In terms of fees, about 0.29%. So this is in the middle of the range between the two. It is on the higher end because they have to track over 1,500 stocks, and these stocks are not only in a developed market index, they have emerging market stocks, so it requires a little bit of extra work or extra management for managing this fund. Now let's look at their distribution. The first thing to look at, so this one they pay out your dividends on a quarterly basis like the first one we looked at, but it's got one of the lowest yields. So this one is only paying out about 2.5% in dividend yield, and I think the last one we saw, the UK one, they paid over 4%. Over 4%. So you're not getting as high of an income in this fund as the last one, which was the UK specific one. But again, if I add up all their quarterly distribution in 2020, I get about $1.626. So that's something to pay attention to. They pay out their dividend in this ETF in dollars, not in pounds. So if you are investing in the UK, if you are an UK investor, the level of income that you get from this ETF will fluctuate based on the FX rate between pound and dollar. And then if you look at some of their portfolio level data, again, because it's a passive fund, you expect the numbers to be similar to the benchmark, so nothing exciting there. And they do hold 14%, which is quite a decent amount, to be honest, in emerging market, and 15% in Pacific. So overall, they have about 30% exposure in the Asian market. And then you have some of their country level allocations. So you can see that even with having Asian exposure, still 40% of the fund is in US. So you're getting a lot of US exposure by investing here. And again, like all other dividend income funds, the largest sector is going to be financial. There is no surprises there. And then I guess let's look at their performance to finish off with. So you can see that you're getting a very close return as the benchmark. So over 1 year, it was up 40%, over 5 years, 9.4%. So these are annualized numbers. So it tells you that if you hold your investment for 5 years on average, or you can expect to get about 9% return every year for 5 years on an annualized level. So to summarize, in terms of how much you can expect to get, say per £1,000 invested, the second fund we saw, the UK Equity Income Fund, is definitely going to give you the highest amount of dividends or income. And the other two funds, they are giving you a similar amount of dividend yield or an income. But remember, with the last one, which was the ETF, they're going to pay out those income to you in dollars. So you're taking an FX risk between the movement in dollar and pound sterling. And if you want to compare in terms of cost, the UK index fund, again, is the cheapest, only 0.14% of cost per year. And that's because it is passively managed and it is only tracking about 80 odd different companies. So it is not incurring a lot of thoughts and process work of the last ETF that we looked at, which was trying to track over 1,500 different companies. But then again, if you compare between the ETF and the first one, both of which are trying to give you exposure to global stocks, the ETF is again cheaper by 19 basis points or 0.19%, because again, it is passive and not active. So the question for you is it worth paying that extra bit of cost for an actively managed fund? To get to that answer, you can look at it in various different ways. One of the ways I would look at is looking at their past performance. So on a longer term basis, the active fund did outperform the ETF by 1.2% on an annualized basis and 9.3% on a cumulative basis. During 2020, it underperformed by 0.6%. However, during down market, the active fund generally did better. But on the other side, when the market was going up, so an up market, it appears to have underperformed. So this active fund generally is good at managing downside risk, so protecting your money when the market is down. Another positive point to consider on the active fund is that it has a lower turnover compared to the passive fund. A low turnover fund means that the fund manager does not trade too often, which reduces the transaction cost. However, that being said, again with the ETF you are getting exposure to over 1500 different stocks, while the other two you're getting exposure to less than 100 stocks. This can be both good or a bad thing. It can be good if you are following Vanguard's 3-fund strategy, something I made a video on before, and that means that you are getting a lot of diversification in your investment. But it can be bad in the sense that by investing in a fund which holds a lot of different companies, you're not really getting a true niche exposure that you may have preference towards, and it can end up over diversifying your investments for you. So the UK one does look good in terms of the fees or the cost and the amount of dividends that you are getting. But the main issue with this UK fund is country specific risk. So you're getting concentrated risk from a specific country. So whatever is happening to that country will impact your investment values, and you don't have enough diversification by geography. Having said that, you can definitely form a small part of an overall diversified portfolio, and it really does help if you're someone who really wants to target getting a higher level of dividend income. But ultimately the choice is definitely yours, and this is all I had to share with you today. I hope you found this video useful. Until next time, look after yourself and your money.